Welcome to the Finance Geeks, a podcast about real financial planning. If you're into numbers, strategies, and building a great planning business, this is your ultimate geeky hangout.
Hello and welcome to Season 4, Episode 10 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute and I'm joined by
Paul Cleworth.
Today we're discussing the Great Pension IHT Shake-up, what April 27 means and what to do about it. But before we start that, we're going to extend this episode over probably 2 sessions because it's quite a meaty one. But we're going to dig in first of all and find out what Paul's been up to. So Paul, what have you been up to?
Been working hard, actually. Lots of client work, for sure. I've been to the head offices at Transact to meet Tom Dunbar, the CEO, the head honcho, Grand Fromage, and Andrew Cullen-Jones, the Chief Development Officer. So I went up to theirs. It was nice. I spent an hour, and I gave them both a rollicking for the Transact website being down for 6 hours a couple of weeks ago, and asked them what they were doing about it. Plus, I gave them lots of input from my point of view as to how the Transact site could improve things that it doesn't currently do that it could. So that was good.
Was there a big ask on there? What's your big number one thing?
Well, I think a lot of it was to do with the, especially at this time of year, the taxable income reports. For clients of ours that are requiring everything from a realised capital gains to their taxable income from their portfolio, broken down with the offshore reportable income on there as well between equity and bonds, and the P60 pension contributions. To get all of that, I said, put it all in one place. Because we've told our clients, this is where you get it from, and we've produced a PDF. But a lot of them expect it from us, understandably.
I completely agree with you. I do think they do listen, though. They're very good like that. They do take on board what their users say and stuff like that. I agree with what you said. The little things could be sharpened up, but hey, they get the main things, the important things right, I think.
They're the best platform out there. There's no question, and I've looked at a lot of them. I was talking to them about ISA subscriptions from previous years because I think it's useful to know. I was talking to them about really making it clear about employer versus employee, like personal versus employer pension contributions, and also in the chargeable gains section when you're doing a realised chargeable gains report for clients for CGT for those with big GIAs. It's useful if you can see the previous years if they've got any losses to carry forward. Mm-hmm. If it was just there showing you, you'd have the information and then you could make a decision. Yeah. So little things like that where the data's there, but you want it to be more visible for you as the advisor.
It'll come.
I went into London yesterday, in fact, with a friend of mine who's a client, and we went to watch Richard Dawkins at Barbican Hall. I thought it was going to be about his book, The God Delusion, and I don't think I read the title properly. It was all, because he's an evolutionary biologist and he's 85 now, it was all about... genetics, of course, and his book, The Selfish Gene, and various other works that he's done. But did you know that he coined the word meme? So he defined meme as it's a cultural unit of information, an idea, behavior, or style that spreads from person to person, evolving in ways similar to biological genes. And we now use memes on Instagram, and people see them all the time online. But he's the one who coined it. Do you know?
Well, do you know what? Since you got that from it, I'm going to rush and buy myself a ticket.
You got to listen to this, though. I asked him 2 questions. They have Slido. Oh, no, you have Slido and you submit questions. So mine didn't get read out because there's
was
lots
it too
of
long?
Ask questions. Well, there was 2 questions. The first one was, do you think society systematically underestimates or overestimates the influence of genetics on human success and life outcomes? But my second one was better. I was hoping he would read it. It was, who's your favourite Gene? Gene Hackman, Gene Kelly, or Gene Wilder?
That
didn't get read out.
That's very good.
I thought that was the best one. I've also been playing golf with my brother, but on one of those simulators. So we went to the driving range. He lives in Sherdington, near Gloucestershire, and we played Royal Birkdale, and we went round in 83. Apparently,
wow.
Because you don't have to. We played Texas Scramble, had a few mulligans, but we didn't have to put it in. As long as you get it within a certain number of yards, It just gives it to you. So
it's good, that, isn't it?
It was something like that. Yeah, it was a really good afternoon, and we'd done a 7.5 mile walk with our dogs earlier on in the day, and then was
that virtually as well?
Yeah, it was virtual. Yeah, they were on the treadmill. No, and by the next day, because we were doing all these, twisting, playing golf, my back was in rag completely. I haven't played in ages. And I don't understand about hitting it lightly or not smashing it down the fairway. It's got to be as hard as possible. The last thing I'll mention is I've been a family man. I've decided to have my son Miles do a bit of work for us. I mean, he does a bit of work anyway, but he was on work experience. And instead of going to some other employer, I had him come in today. So I made sure he looked the part, he looked smart. And he was sat down and we told him what to do. I took his phone off him. He was doing a really good job. And Catherine, our practice manager, has been cracking the whip and getting him to do some archiving online and do some admin. He's suffering at the moment because he's just had braces.
Okay.
So he's had braces, and then a week and a half ago he got kicked in the face and had his nose broken.
Oh God.
Yeah, I know. But he's been tough about it and went into hospital and they put it straight. So he's been in the wars recently. What about you, Warren? What have you been up to? Do
Well, we're in Norway for a few days, Nikki and I, with some friends. Had a great time over there.
you recommend Norway? I've never been there.
Do you know what? I've got to be honest. I was there when you had the heat wave over here. So it was wet and cold, and I was there, and you were here, and I was...
Maybe you went the wrong time of year.
Yeah, it was all right. It was okay. It was nice. I love the people we was with. We had a great time, but would I race back at that time of year? Probably not. I'm a nice weather kind of guy.
You should get a camper van to go round, or a motorhome to go round Norway.
Nikki won't go in a camper van.
She didn't do that. Okay.
No.
Okay. Next.
Let's Four Seasons make a camper van. Jimmy Carr was very good. Went down to Oxford to see Jimmy Carr with Ollie.
You did. He's
that was
brilliant,
great.
isn't he?
Bit more sad. We had a client pass away. We looked after a couple. Husband died about 12 years ago.
Yeah.
And so the whole office went to near Bristol for a funeral.
Wow.
So we had that amazing time in London. You and I went in.
We went to watch Lords, didn't we? To watch England versus New Zealand, the first day of the first test. That was calorific. That day.
That was good. It was a good time.
Yeah.
And Tuesday this week, we just come back from Take That. So we had a corporate box for some clients.
Are they still going?
Yeah, they were fantastic.
Without Robbie, just the
without Robbie.
ones.
But just I think Jason's not there either. Is it just the three?
How old are they now? They must be mid-50s or older.
They're still, hey, we had a great time. And a lot of the clients were drinking Gary Barlow Chardonnay. I didn't try it myself, but apparently it was quite good.
Is that a thing? Is he a winemaker?
Yeah, he's got a bottle. Well, no, he makes wine if he just puts a label on somebody else's wine. But it was
he
good.
imports from France or Spain.
Do you know what? And I think for financial advisors listening to this, I can't emphasize enough of having, and you've mentioned it just then as well, social events for your clients. It's a nice way to give back and say thank you, just to relax, get to know them on a deeper level and stuff like that. So we really enjoy that.
We got that feedback from our clients about going out for coffees. It doesn't have to be a big event or a big social or a big meal or anything. It can just be meet for a coffee or for lunch or a catch up at their home. A lot of them said that that's kind of what they wanted often. So
is it because you serve bad coffee then? Is that what it is?
We serve great coffee.
Let's go out for coffee.
We even put little tea in the top of ours for tandem.
God,
yeah.
And it's been a bit stressful this week because it's the week before the big party tomorrow. So we've got the big 20th anniversary party for Lexington. So we've got about 90 people now coming.
Very good.
Is a total. So fingers crossed it will go well. I'm sure it will be.
You got the weather for it, haven't you? If it's all outside,
I've got the weather for it. But when we started planning, it was rain, so I've lined the outdoor building with make it all look pretty. So that's all ready to use, just in case it wasn't nice.
All food, all wine, all inclusive. I'm going to rock up, I think, and just take advantage.
Outdoor, great chef. He cooks outside. We've had him dozens of times. So it's entertainment as well, so people can see him. Always have a magician at these things. We've got a magician coming. Darren's used him loads of times. Magicians are great. Okay, so if you think of a social event, a magician goes in, everyone crowds around them, they do the magic, everyone goes, wow, the magician sneaks off, and then the group carry on talking about the magic and then build a conversation. So it's brilliant. And then we've got a band as well, Len Morphew's jazz band. So they're very, very good. So it'd be great. Really, really good. So we'll enjoy it. Can't wait. But what's more important, Paul, is the main focal point of today's podcast, which we're going to... It's a big one. So we're going to cover probably 2 sessions on this. So, where do you want to start?
It's been the main topic of conversation in lots of client meetings over the last 6 months. I mean, even when it was introduced. And it's been a long time coming as well, because it doesn't actually come in, as you know, until the 6th of April 2027. But I'm trying to think when it was originally announced. Was it in 25? I mean,
over a year ago, I think.
yeah, it was. Here we are. It was confirmed in the Finance Act 2026, and it got royal assent in March 26. And I think that what you can't do with these things, because we did a session on this a long time ago, actually, when it was originally publicised and suggested by the government. But we were waiting for both royal assent and just to see how it was going to actually play out. And it's not as if it's going to go away anytime soon. And with the average sort of client value, if you like, that we work with clients' assets, even their homes, many of their homes are over the £1 million allowance for 2 nil rate bands, 2 residence nil rate bands. As soon as that's the case and you suddenly bring pensions in, there are implications, aren't there? There's the 40% is not a small amount of money to have to cough up. Yeah, the discussion has been more about what do we do about it, because I don't think there's any point in just sort of burying your head in the sands and just hoping that it goes away, or just thinking it's okay because I'm married, and if I die, my spouse will receive the pension on death, and that's true. There's still, as you know, no inheritance tax between spouses, but it's what happens after that, and it's the fact that there are bizarre scenarios where if someone's got an estate sizably over 2 million and that they add the pension in, they get past 75, they can pay both inheritance tax on the pension, and then the recipients pay income tax as well. So I'm not a big fan of how it's come in.
I know you know this because we've spoken about it before, but I think it's important for other listeners. I'm going to use the word domicile. I know the terms have changed to long-term resident, but it's much cleaner when you say domicile. There's no inheritance tax when they're domicile. Okay, so if UK domicile, non-domicile, there is. So if you've got clients who are married to European people or overseas people and stuff, you need to scratch below the surface a little bit more. But the impact of this is now bringing, I'm going to say, I'm sure it's an exception, but I'm going to say all of our clients into the IHT loop. Whereas before we had exceptions where people might have had huge personal pensions and a home, but that fell within the allowances, and they could probably escape with a little bit of planning the IHT liability. But big issue.
Hey, it gives us a job. I mean, it makes the planning element and the strategy part of it much more relevant. I mean, for over there's a couple of things that I need to make clear here. For over a decade, pensions have been sort of the crown jewel of estate planning. You've got money that used to be outside, or still currently is outside of the estate, and no inheritance tax. And those that were wealthy, had big pensions, money purchase pensions, group personal pensions, those other than final salary defined benefit, they would max them all out, get tax relief going in, and then saying, this is good, I will hold this money over here, growing tax efficiently, no income tax, no CGT, and I'll gift it in the future. I don't need it. A lot of people didn't need it. And they would just leave this pension untouched. And I think the government have sort of come around to the fact that people were using the pension instead of for retirement income. It was to sort of pass money, down to their children in the future and grandchildren and so forth, and have it tax free. And the second thing I would say, really importantly, is it's not been the case that in the last 15, 20 years, 30 years, that pensions have been free from death taxes. It's gone up and down like a yo-yo. They brought them in. There was times when the pension allowance was higher, the lifetime allowance was higher. Now there's no lifetime allowance. There was times when the death benefit after a certain age was 35%, then it was 55%. And then it was nothing, and now it's coming back in. So it's not actually new that they're bringing in essentially a death tax on pensions, is it?
No, but I think the more they meddle with pensions, the less confidence people have in them, and less confident people are going to build up meaningful pensions. And if the government is trying to create an independent estate of civilians who don't have to rely on them for benefits in future years, they need to encourage this. I think they are bloody crazy. The real simple change they could have made, which would have made a difference, I believe, would be to change the death benefits pre-age 75. I think, as I'm sure everyone knows, at the moment you die pre-age 75, the death benefits pass tax-free to whoever you nominate. Just adding an income tax payment to that would have changed things massively and made it a lot more okay. I think it's daft that it's tax-free anyway, if I'm honest.
You're absolutely right about encouraging people to save, and just to get to it, the those in Parliament that make these decisions, MPs who either don't understand how pensions and finance work, but who have also got gold-plated defined benefit pensions, and they do, and they're making arrangements here for those with personal pensions and saying, oh, by the way, now there's another rule to contend with. And I think, as you said, the more complicated anything is, the less people want to look at it. And this is why ISAs are really an obvious first thing that you look at, first tax wrapper you generally fill if you're a first-time investor, just to get it into a vehicle where there's no income tax or CGT. And of course, we've got that future rule coming in, haven't we, for those under 65, where I think it's 2028. ISAs, the allowance is going to reduce from 20,000 to 12,000. But I think some people might feel that they just don't care that this rule is coming in because it'll just affect the wealthy. But we're noticing that that's just not the case.
Oh, no.
This is going to affect a lot of people.
It is.
And it's almost the majority of my clients, if not all of them, in terms of what they need to take action against it.
Yeah, no, absolutely. It's a real shame because I think they're really shaking the confidence in pensions, and I really don't think any future government or party getting into government is going to change it back. I think once these rules come in, they rarely go back. Like you said, we've had lots of change around the pensions, but I don't think they'll reverse this.
Not to get overly political, but there have been MPs recently, previous prime ministers, not naming any names, who've very vocally said that pre-COVID, the number of claimants for welfare were 2.5 million, and now it's 5 million. The amount spent on welfare now, and it's doubled in the last 6 years, the amount spent on welfare now is the same as the amount spent on defence. And what you cannot have is a situation where people are better off not working than working, and that you then say, well, okay, what I'll do is I'll tax the wealthy, I'll tax the rich. And there's we're talking about tax on pensions, yes, but there's future taxes that will probably come in, the extra council tax effectively for those with houses over 2 million. Boo-hoo, but some people are going to pay more tax. Possibly a wealth tax has been talked about. They've got one in Spain. It's quite unsuccessful in terms of how much tax it raises. And when you look at inheritance tax generally, the amount of, up until now, of tax that the country receives, which is about $1 trillion a year, about less than 1% of that is from inheritance tax. Right. So it's going to be the case that that's going to increase almost certainly, but to what end? It's going to be detrimental, as you say, to savers, to those actually are going to take the initiative to save for their own future. And if you sort of say pensions are no good anymore, or you give people that impression because they're complicated and perhaps seen as tax inefficient, where do people put their money? In property again? Property is already very high in value, and it's lost its
shine.
Its shine because of tax inefficiency, and very few of our clients would do that. So what's happened, of course, and perhaps not, of course, but it's certainly the case, I think, and Transact confirm this, is that the number of applications into offshore bonds has gone through the roof. People are saying, well, I've got this surplus monies, I don't want to pay extra capital gains tax and put it in a GIA. I've maxed out my pension and my ISA. Where can I put it? And they'll put it in offshore bonds.
Offshore bonds are a great vehicle for growing investments or capital over a period of time. We really like them. Which way do you want to go with this next? You want to talk about sort of...
Well, I think we need to clarify the rules a little bit more, because although our audience is largely financial planners, it's not as if a lot of them don't know it, but I think that perhaps some of it's misinterpreted. There are nuances in terms of the how all of this actually plays out. And knowing and reading the rules is different to saying, okay, what can I do about them? So we need to firstly establish what some of them are. So we know that when we put money into a pension, we get our marginal rate of tax relief. And I spoke to an advisor the other day who was working with a client with an income of about 130,000 and had a lump sum. And this was quite interesting and very relevant to today. Lump sum of about bonus of about 380, 400,000 pounds. Happened to be single, happened to have a child, divorced, and didn't have a very big mortgage. So when someone says, I've got new money, what do I do with it? The order of play almost always for my money is pay off expensive debt, credit cards, loans, consider that. Not always car finance, depends how it's set up. Consider overpaying mortgage, not always, depends on the rate and the redemption penalties. Top up cash, very important for me. Fill ISA, and then usually it's fill pension. But if someone's at 130,000, you and I know that the 30,000 that's above 100K, there's a band there of about 25,000 where they're effectively paying 60% tax. So, your eyes light up, the alarm bells go off when you see someone's income in a fact find or a cash flow, and it's just over 100K. You're saying, can they make use of a pension contribution? So you do the numbers, you do the maths, and it might be the case this person with a 400K bonus could say, their advisor might say, well, put 130,000 gross, 100% of their income into a pension. Actually, I disagreed with that with this other advisor because I said, there's no point maxing out the pension to the point where by the time the person gets it, they're only getting 20% going in on 50 grand of that contribution. And when it comes out, they're going to both pay in potentially higher rate tax and not being able to access it till 57. And then because they're single, they haven't even got the spousal exemption to pass it to a spouse on first death. And so you're building a bigger pot when they've got a house that they might bequeath to their child and they've got a pension, and all of a sudden their assets are way in excess of 500,000 for a single person. You're just asking for more and more tax. You're kicking the tax can down the road. And so, yes, marginal rate, especially higher and additional rate on pension contributions going in. I like that. And when someone's got a point where it's considerably above $1 million, let's say I like the number of about 1.3, 1.4 million. I mean, listen, this is for people who can get decent sized pensions, but that's optimal for me because when you come to take it out at 55 or what will be 57, you take your 268 and a bit thousand tax-free cash out, and you've got enough of a pot when you draw it to still be a basic rate taxpayer. Your 4.5% withdrawal rate.
Right. Okay. So what you're trying to say is you're being taxed on the way out at a lower rate than you got tax free.
Yeah. That's where pensions are optimal for me, where you're getting higher rate and additional rate. Are they appropriate for someone who's a basic rate taxpayer? Yes and no. You're getting tax going in 20%. You can use, as you know, your personal allowance when it comes out, and it depends on your other forms of income. But if someone's let's say builds up a pot of only 400,000. 100 grand tax free, 300 grand drawing income, and again at 20%, there's no NI coming out. And so it can be effective. But when you factor in now that if they've got a home, an ISAs, cash GIA, and a pension, and all of a sudden, even for a married couple, it's way in excess of £1 million, their combined allowances, what you're going to find is eventually, unless both spouses live a long time, there's going to be both inheritance tax on that pension above $1 million and income tax for the recipients post age 75. So I kind of like the age 75 rule, and I think it's this idea that, and I in my pension beneficiary expression of wishes, I had a discussion with Tom Dunbar about this as well. I said I think that Transex should elaborate and encourage their advisors to elaborate on how you phrase the expression of wish. For example, if you just say, 100% wife, that's all you say, or 100% husband, and you don't think it through to say pre and post 75, and what happens if my spouse predeceases me, and then when they get to above 75, where we know that it's taxable on first to the recipient, whether they're married or not, it should be, suggested to you by the website to say, think about children and think about grandchildren, because on receipt, they can still all use their personal allowances. So I've got a client who's got 13 grandchildren. We've sent, he don't need the money. It's all in his pension and he's 80. And we've just set it to 13 different kids and about 20,000 each. Well, they can draw that money when he dies, and even though it's taxable, and assuming there's no IHT or that's taken care of, they can draw 12,570 a year tax-free, because they can use their personal allowance. So you've got to think about, and it's part of the discussion, who are the beneficiaries going to be of this pension? And the bigger it gets, the more complicated the strategy needs to be, especially if you're between the sort of 2 and 2.7 million when you start to lose your residence nil rate band. And so you do get lots of cases. I've had them recently where a couple have got a expensive home, 1.5 million, assets now considerably in excess of, in total, of 2.7 million, and they've now lost their residence nil rate bands. So their combined allowances are only 650,000. And with that in mind, with a massive pension, I've got this particular client drawing £100,000 a year taxable out of his pension. He's had all his tax-free cash. We're literally using the band up to 100. So he's paying higher rate tax on it, of course, on quite a lot. But it's worth doing to get it out now and pay the tax now to enjoy the money, rather than just let it grow and grow and grow and grow and grow. And then two things will happen. There'll be inheritance tax on this 40%, and then the recipients will pay income tax at their margin rate as well.
But I guess with that client there is, if he was going to enjoy the money anyway, irrespective of what the IHT rule changes, he would have done that same strategy, right?
Yeah, I suppose so. But you do get scenarios where people are drawing, let's say, the 4% figure that we talk about. It's not really a rule. It's just a very typical figure that a lot of advisors work on. If a client's older or has longevity issues like health issues, if they're going to downsize, if they're going to inherit monies, you might as well draw more monies out. We talk about, Bill Perkins, die with zero. What's the point in only drawing the very smallest amount out? Pensions, our Cairngorm's model, 100% equities, has gone up 30% in the last 12 months, net of fees. Quite unbelievable. And although you've got to account for future downturns in markets, if you're going to draw an extra lump sum out of your portfolio, now is as good a time as any to do it, to top up cash, take a bit off the table if you like. Not too much to not account for the future, possible declines or likely declines. But, you've got to adjust accordingly. And those adjustments throughout the year and throughout a client's retirement years is where the advice really comes in.
Yeah, I agree with that. It's really redefining retirement planning and estate planning. It's really thrown a massive spanner in the works. And arguably, making clients really, or should make clients seek advice. And go and get things reviewed.
Yeah.
So no, that's fair enough.
Let's talk about what's not changing, because some of the exemptions, we've still got them. We can't suggest or conclude in this podcast that pensions are just no good anymore. I think that for those saving for their future years, there is probably an optimal scenario. Once the balance is right between spending and saving and paying yourself first, as we talk about, saving monies for your future years, I like clients to sort of top up their cash a bit, save regularly into ISAs, often 10 to 15% of their monthly income, and then pensions, again, sometimes 10 to 20% of their monthly income. Depends on lots of things and whether they've got kids in paying school fees for kids and what their affordability is. But the regular contributions, the habit of the regulars, and getting the tax relief at source is super important. And the compounding over time, it's still building your wealth. For me, is just initially ISAs and pensions. If you've got swimming in money and you've got more, you can look at other vehicles, not necessarily property. I think it's largely dead in the water unless it's some HMO or possible holiday home you want to deal with. But generally, I'm not a big fan of it. Once you've maxed those out, it's GIA in the wife's name or husband's name, whoever's the lower income earner. Don't want to be called sexist. And then of course it's looking at alternatives or esoteric type wrappers, offshore bond, for sure. But the spousal and for spousal spouses and civil partners, I don't want people to forget that there is just no inheritance tax between them. So super important that people consider, if they're not married, getting married, because you build up a big pension. The last thing you wanted to do is for loads of it to go to the government on first death. If you're married, at least it goes to somebody, your spouse or civil partner, tax free.
Nikki laughed because she thinks I've married more people than the local vicar. So the number of our clients who were single cohabiting who are now married, goes way in excess of 10, 15, yeah.
And the death in service tax rules and pension tax rules, I imagine, like myself, you've dealt with lots of clients that have died and that you've transferred monies from the pension from one person to another, husband to wife, wife to husband, or to kids. You've dealt with that, haven't you?
Oh, yeah, definitely. Yeah, I've got to say, majority of our pensions, even today, the death benefits are written into trust, even if they're more modest in size.
Asset preservation trust or asset protection trust?
Yeah, so that's okay. So for financial advisors listening, that is a badge that's put on a discretionary trust.
Yeah,
So there are only three types of trust. A discretionary trust is one of them. So we do that, an asset preservation trust, or AKA a discretionary
yeah,
trust.
yeah,
The rationale for me behind it is I want to get as much money out of the estate as I can, so that the effect of inheritance tax doesn't compound. So we've just been talking about that our client's going to pay inheritance tax. That money's going to go down to the children. Let's use round figures. They're going to receive 60% of it. They're going to have an estate themselves. When they die, that estate's going to pay inheritance tax again. So that
yeah.
60% they receive is going to lose another 40%,
I
and
can
so on and
see
so
why
forth.
you do that. I can say, I mean, it's giving control, ultimate, and flexibility, and choice to the trustees, essentially, of the trust for the pension assets. And this tactic half the time is there's three phases as I see it. There's pay money in and contributing. There's the drawing the money out and the how best you do that. Is it flexi access drawdown? Is it annuity? Is it sort of some other strategy? And then it's what happens and what
Yeah.
do you want to actually happen on death. So do you have a sort of I looked at the stats on this the other day myself. Of the monies that we manage as a business, 55% now is pensions, and 20 years ago, it used to be 75-80%. I don't know if yours, as you've matured as a
Yeah.
business, whether the pension levels go down and things like ISAs, GIA, and offshore bonds go up.
Yeah, I'd still say it's the majority, and I'd probably say it's around about 60%. I couldn't tell you
It's
exact
about
figures,
60.
but I'm that's off the top of my head.
Yeah, yeah,
That's
yeah.
what the theme's about, right? We have a lot of quite large GIAs, but equally have a lot of large offshore bonds as well.
Yeah, yeah. Yeah. Let's talk about annuities and whether there's going to be a sort of resurgence of their popularity, not just after April 27 when these new rules come in, but before, for people deciding, okay, how best do I draw my pension benefit? Are you finding that you're sort of setting up more annuities, or not at
Yeah.
all?
We're certainly discussing annuities a lot more, and we're discussing the rates and the impact and the benefits and the pros and cons. I think if someone has poor health or a shorter lifespan, expected lifespan, then yeah, they can be great income rates there for some of the money. I
Mm.
wouldn't necessarily be annuitizing all the money unless you have a relatively modest pot, and you might just want to annuitize the lot.
Yeah. It's interesting that we just had this big increase in markets. Annuity rates are higher now than they certainly were for a 10-year period after the financial crisis. And even though, and despite interest rates in the UK, the base rate being 3.75, and it's been as high as 5.25, it appears to me that for someone who's about 60, 65, you can get rates above 6%. And so you ask yourself, okay, so if I do get 6%, that's usually 6% level. You start adding on joint life and dependence pensions and guaranteed annuities and value protected annuities. And if you
Start
start putting
dropping
in
down.
indexation, the rate starts dropping down.
Oh,
And and
massively.
it and it's I'm just saying two things there. I'm not sure that all advisors and certainly all clients realize that you can just use part of your pension to buy an annuity and do drawdown with the rest. But also that if it is a 5% rate and it's level, you do have to live 20 years just to get your money back.
Yeah.
And it's just not difficult maths, that, but
It, it, it,
it's kind of how you look at it. Do you want the certainty? Do you want the guarantee? Do you want
yeah.
more money now and less money later?
I think for some clients, it's an appropriate solution. I still think most of our clients want succession planning, building wealth for their families, their children, and future generation. Hence, the use of trust is a lot more important to them than having an extra level of guaranteed income.
The thing that's perhaps not that could be overlooked as part of these new rules coming in is if those people are concerned about pensions coming into the estate and the inheritance tax implications. There are other things you can do to mitigate inheritance tax. One of which, the simplest one, really, assuming you can get insured, is life insurance. And I think for a long time, I perhaps would meet advisors and probably, I'm not sure if I thought this myself, but where they'd say, okay, I've worked out the inheritance tax liability, it's 500,000. I'll just get a life insurance policy, whole of life, probably, possibly a term assurance policy, but that doesn't work if you live beyond the end term, for this liability. And then I can do what I want. And you're going, yes, but there's still an IHT liability. It doesn't just get rid of it. you just got to use the life insurance to pay the IHT. So it's this point that when it comes to actually completing the IHT 400 form and submitting to the probate department and sort of working out with all the assets and the values and saying, right, this is the liability, the trustees of the life insurance policy, which might be the executors of the will, would coordinate, who are also the trustees of the will, say, okay, can you pay me this money so I can pay the tax man? Because then I can distribute the assets. So life insurance, I think, is probably going to get a surgence of people bothering about life insurance, specifically whole of life, joint life, second death, to mitigate this liability.
Since the rules were announced, our conversations around this have increased. And then since it achieved royal assent, we have probably done more whole of life business, I think, in our whole career. I've been running 20 years this year. We're doing a phenomenal amount of taking tax. This is for those people whose plan was to use the pension for succession planning.
Sure.
So they've got enough income and enough capital to last the rest of their life. This was really for their children to inherit. We're crystallizing tax-free cash, which is normally the maximum, pushing that off into a trust. So we've got that ticking. And then we're starting income on the pension through drawdown and buying this insurance to cover the liability. And if you compare the number of expected premiums versus the payout, you can communicate it one or two ways, but typically the individuals would need to live way past 100. We're talking 110, 120 to pay in more than they're going to get back out. Or they could be looking at getting like an effective discount on the benefit, the inheritance tax liability, of anything about like 40 to 50%. It's quite massive.
Thanks for listening to part 1 of this Finance Geeks episode on inheritance tax changes coming in 2027. We will return for part 2 in a couple of weeks.